So the enhanced income fund. So people, sometimes call it hybrid fund, but ultimately it's credit fund. We invest in senior credit, we invest into bank hybrids, we invest into corporate hybrids, and we invest into subordinated debt. Now, from my point of view, all those securities have different risk parameters, and therefore you need to actually have a very diversified portfolio. So we currently have around 75 to 80 securities within our portfolio, historically somewhere between 60 to 100, but that's always dependent on the opportunities that are presented at any one time. The uniqueness of the enhanced income fund is also its floating rate. We're very lucky in Australia that we actually have a market that provides floating rate securities. There's a lot of markets around the world that don't provide that. In particular hybrids. So because banks tend to lend on the variable side of housing loans, companies issue floating rate securities to match their asset and liability. So one of the beauties of the enhanced income fund is we actually invest into those floating rate securities. And in a rising interest rate environment like we have today, there's probably no better place to invest. I think one of the key things is about, and this is not just about the enhanced income fund, it's about Yarra and the way we go about markets, is that we're a very research-driven business. We believe the more research we do, the better returns we'll get. And if I bring it back to the enhanced income fund, I think one of the key things for us is that we don't have a benchmark that we actually measure ourselves against. We try to give a cash plus type target return, which we've done and exceeded for over 20 years our target return. So I think one of the keys for us sometimes in credit is it's not about what you own, it's about what you don't own. And having that flexibility to navigate markets. And particularly this year, it's going to be really important to navigate, to be invested in the right sectors of the market. But research is the starting point of it. But also the one thing that's quite unique about the enhanced income fund is its floating rate in nature. It tends to invest in around 75% of its portfolio in floating rate securities, or 85% in floating rate securities today. That's one of the other unique things about it. But I also say about our process. Our process has been evolving for 20 years, and I have a very experienced team to help me with that research and understanding of the credits that we invest in. It's everything. The key, you'll hear the word duration mentioned a lot. And one of the things about fixed income markets, if you're buying government bonds, semi-government bonds, they tend to come with a lot of duration, what we call duration risk. And all that means is that if interest rates rise, you potentially can lose money from that rising interest rate by investing into fixed rate securities. By investing in floating rate securities, our interest rates are reset every 90 or 180 days. And given that we've got that expectation that rates are rising, and I used the example earlier that March 23, at one point the cash rate or the 90-day BBSW is forecast to be 3%. That's our base rate, and then we earn our credit margin above that. So by being in floating rate, we don't experience any capital loss. And that's really important in a rising interest rate environment. There's a lot of people in the market today have never seen interest rates rise, because it has been a long time. And I think the one thing that we've called as a house, in particular Tim too, we've been talking about inflation rising for a long period of time. So we've been very well positioned for that. We've been hedging out all our fixed rate securities, hedging against the right part of the yield curve, which is really, really important as well. So that rising, interest rate that we've seen, we're not losing any capital loss in the enhanced income fund. So we're actually getting an uplift in yield. So every time the RBA starts to tighten policy, we get increased income, higher yield. And if 3%'s right in March, 2023 next year, we're going to be having a running yield on this fund in close to around 6%, which is, in my eyes, it's been probably 10 to 12 years since we've seen that type of return and running yield across an investment grade portfolio. So I find that exciting. I think investors will find that exciting. And as I said earlier, I think it's probably a good place to be in the current environment that we are as investors. The Enhanced Income Fund always tries to be investment grade on average, and we've done that for over 20 years. But we do have the ability to go down into the higher yield, what we call higher yield with non-investment grade type credits. And it's really interesting today, the funds on average is around BBB, and that's at the security level, not the company level. So for us, we're probably running the highest credit quality that we've been running for probably 10 years now within our fund, and that probably suits the time and environment that we're moving into. So today we run around 75% investment grade credit and around 25%, which is rated non-investment grade and below, what we'd call high yield. And that, just to bring that into context though, we tend to be, because we invest into hybrid securities, I'll give you regional banks today, their tier one paper is non-investment grade at BBB+. And I think that's really important, is that they're still quality companies at the senior level. It's just that subordination in hybrid knocks it down into that high yield level. But I think that for us, we're moving into an environment which is a bit unknown with interest rates rising. We don't know the outlook for growth. So it's really important to stick to high quality companies, and in particular companies that, and sectors that probably aren't exposed to discretionary spending, which is something that we're trying to avoid in our fund. As you're taking risk, you should be compensated by a greater return. So for us, we always think about, and I said earlier, the rule of thumb for us is that get paid for the risk you're taking. So assigning that Yarra rating is our tool that tells us where's that starting point. Now, whether it's a senior credit or it's subordinated to that, we will notch for various risks within a security. So the most important thing for us is we need to get a compensation or return for that. So adding that value by taking more risk is how we go about developing a portfolio that is ultimately investment grade on average, but is going to give us roughly a return of around 260 to 270 basis points in compensation for that investment grade portfolio. Now you add your BBSW in 12 months time where cash rates will be at roughly 3%, that's where we get that 6% type total return that this fund will offer. It's a good question because I've seen that evolve over the last 12 months. What a lot of clients have been doing is identifying that interest rates were rising. So what they've been using is to, instead of getting rid of their, what we call their interest rate duration, what they've been using is EIF, because we're floating rate with very little interest rate exposure, and bringing the two together, enhancing their yield, but more importantly, probably halving their interest rate risk and their exposure to rising interest rates, which has been quite interesting for me because I actually haven't seen clients do that in the past, and it makes a lot of sense from my perspective.